Usually when we sit down to record this, we are looking at price charts. We are talking about support levels, green candles, red candles, the noise of the market. But looking at the briefing for today, Wednesday, February 11, 2026, if you just look at the price, you're going to get run over.
Completely. If you are staring at Bitcoin dipping below 67,000 this morning and thinking, oh, standard correction, you are missing the forest for the trees.
Because the phrase that jumped out at me from the intelligence briefing wasn't about price. It was this specific term, a regime of tactical rebalancing. It sounds corporate. It sounds, boring. But when you dig into the documents we have today, specifically from Goldman Sachs and Morgan Stanley, that phrase is actually screaming that the game has changed.
It is the difference between gambling and engineering.
Yeah.
That is what we are seeing. The general public sees a red chart and panics. But the smart money, and I mean the heavy hitters, the institutional capital, they aren't leaving the casino. They are just ripping out the slot machines and installing power plants.
That is exactly what we need to unpack. We have three massive stories that broke in the last 48 hours. First, the smoking gun 13F filing from Goldman Sachs that dropped yesterday. Second, a report from Morgan Stanley that basically says miners aren't miners anymore. And third, a mess of a situation in Washington, D.C., contrasted with a massive scandal in South Korea.
It really is a forensic analysis today. We need to look under the hood of the machine, not just the paint job.
So let's start with the big one, the money. We got our hands on the fourth quarter 2025 Form 13F filing from Goldman Sachs. For the listener who isn't, refreshing the SEC database every day, why does this document matter so much right now?
So the 13F is the truth serum. Every quarter, institutional investment managers with over $100 million in qualifying assets have to disclose their holdings. They can go on TV and say whatever they want, but they cannot lie on the 13F. And Goldman's filing showed a massive pivot.
Pivot is putting it lightly. They dumped Bitcoin. They held about, $1.06 billion in Bitcoin ETFs as of December 31st, 2025. And according to this filing, they reduced that position by 39.4%. That is a huge chunk of change to move.
It is, but you have to look at the timing. This is what separates the pros from the retail investors. When did they sell? Fourth quarter 2025. Where was Bitcoin then?
It was flying. We were near the cycle highs, around $112,000.
Exactly. They sold into strength. They executed a classic de-risking maneuver. If you do the math on the slide from 112K down to where we are today, roughly 67K Goldman saved themselves an implied unrealized loss of about 45%.
That is why they get the big bonuses. That is career risk management 101. But here's the part that I couldn't wrap my head around initially. Usually when a bank sells that much crypto, the narrative is crypto is dead, we are going back to bonds. But they didn't go to cash.
No, they rotated. And this is the tactical rebalancing we mentioned. They took that Bitcoin profit and moved it into what they're calling altcoin-denominated physical infrastructure proxies.
Which is a lot of syllables to say they bought XRP and Solana.
It is a mouthful. But the why is fascinating. They disclosed $152.2 million in XRP ETFs and about $109 million in Solana.
Okay, play devil's advocate for me here. Because to a Bitcoin maximalist, someone who believes Bitcoin is the only true asset, this looks insane. Why would the biggest bank in the world sell digital gold to buy XRP, which has been around since the dinosaur age of crypto, and Solana?
Because they aren't looking at them as currencies or stores of value in the same way. They were looking at them as commodities. Think about a traditional portfolio. You don't just own gold. Gold is your store of value. It sits in a vault and looks pretty. But you also buy oil because you need energy. You buy copper because you need to build wires. You buy wheat because people need to eat.
So in this analogy, Bitcoin is the gold.
Bitcoin is the gold. But Goldman views XRP as the copper. It is a settlement rail. It is plumbing for cross-border payments. They don't care about the community or the memes. They care that it moves money from point A to point B cheaply. And Solana, that is the high-speed rail. That is network infrastructure for applications.
So they are industrializing their portfolio. It is not number go up. It is what does this thing actually do?
Precisely. It is a multi-asset allocation model based on utility. They are betting that the next phase of the market isn't about hoarding coins. It is about using the networks. It's a transition from speculation to utility.
Which brings us perfectly to the second big story.
Right.
Because if the banks are buying the software utility, it looks like the miners are trying to corner the market on hardware utility.
This is, in my opinion, the most significant narrative shift of the last 72 hours. We have a new report from Morgan Stanley analyst Stephen Bird specifically, and they have completely re-rated the Bitcoin mining sector.
And for those who don't speak Wall Street, re-rating basically means we were wrong, and now we are changing the math on how much you are worth.
Correct. For years, you valued a mining company based on one thing. How much Bitcoin can you produce? That was it. But Morgan Stanley is saying that model is dead. They aren't looking at hash rate anymore. They're looking at megawatt capacity.
They are looking at power.
Power for AI, artificial intelligence.
Okay, so let's look at the winners and losers here, because the report plays favorites aggressively. They have listed Cipher mining ticker CIFR and TeraWulf WULF as overweight, meaning buy them now. They slapped price targets of $38 and $37 on them. Why them?
Because they pivoted. These companies realized that mining Bitcoin, which uses the SHA-256 algorithm, is volatile. The price crashes, your revenue crashes. But hosting GPUs, hosting the chips that power ChatGPT or DeepSeek, that pays steady rent.
So they're becoming landlords.
They are digital infrastructure real estate. Think about the bottleneck in AI right now. It isn't just chips, it is plugging them in. Getting a grid connection in the U.S. takes years. But these miners, they already have the massive transformers, they have the cooling systems, they have the plug sockets.
So they are sitting on the most valuable resource in the tech world, immediate access to electricity.
Exactly. And they're using that leverage to sign massive contracts with hyperscalers, the Amazons and Microsofts of the world. They are leveraging their position to become the backbone of AI compute.
But then you have the loser in this report, MARA Holdings. Ticker MARA. Morgan Stanley hit them with an underweight rating and an $8 price target. That is a brutal spread. 38 for Cipher, 8 for MAR.
It is brutal, but it represents the new logic. MAR is a pure play. They are loyalists, they hold a ton of Bitcoin, and they mine Bitcoin. In 2024, that was a strength. But Morgan Stanley now calls that a structural vulnerability.
Because if Bitcoin drops to 60K, MARA bleeds. But Cipher still collects rent from the AI companies.
Right. Wall Street hates volatility. They love cash flow. MRI is high risk. The hybrids are infrastructure plays. We are even seeing companies change their names to reflect this. Look at Bitfarms.
Yeah, I saw this. They are moving from Canada to Delaware, which is where you go if you want serious U.S. capital. And they are rebranding to Keel Infrastructure.
Keel Infrastructure.
That doesn't sound like a crypto bro company. That sounds like a utility company that my grandfather would invest in.
That is the point. It is the REIT endgame real estate investment trusts. They want to be boring. They want to be the plumbing. They want to be the guys who own the pipes, not the water flowing through them.
So we have banks treating coins like commodities. We have miners becoming power plants. But you can't build a new industrial age without rules. And this is where things get messy. Let's talk about Washington, D.C.
This is polite. Gridlock is probably more accurate.
There was a major meeting at the White House on February 10th. You had the banking lobby, the ABA, BPI, sitting across the table from the crypto heavyweights, Coinbase, Ripple, A16z, and Treasury Secretary Scott Bessent tried to broker a deal on the Digital Asset Market Clarity Act.
And it failed.
Why? What was the sticking point?
Yield. Plain and simple. The banks are terrified of stablecoins paying interest.
Okay, walk me through this. Right now, if I have a stablecoin, a digital dollar, it usually just sits there.
Right. But the issuer of that stablecoin takes your real dollar, buys U.S. Treasuries, and earns 4 or 5% interest. Currently, the issuer keeps that profit. But the crypto industry wants to pass that interest on to you, the user.
Which sounds great for me. Why would I keep my money in a Chase checking account earning 0.01% if my digital wallet pays me 5%?
And that is exactly why the banks demanded a prohibition principle. They went into that meeting and said, if you allow stablecoins to pay yield, you will drain the $19.7 trillion deposit base of a U.S. banking system.
They are protecting their cheap funding.
They are protecting their existence. If the money leaves the banks, they can't lend. It causes a credit crunch. So the banks demanded a total ban on yield for retail users.
And the crypto companies said no.
They refused. Coinbase and Ripple stood their ground. They argued that banning yield is anti-competitive. They essentially said, we shouldn't be punished because your product is worse.
So the meeting ended in an impasse. The legislation is stuck. It is a classic incumbent versus innovator fight. But meanwhile, while the U.S. argues about interest rates, South Korea is dealing with a nightmare scenario that highlights a totally different problem, the ghost coin scandal. This story, it is wild.
It is a cautionary tale that justifies why some regulation is actually necessary. Bithumb, one of the biggest exchanges in Korea, had an operational meltdown. A staff error, literally a fat finger mistake or a coding glitch, mistakenly credited 620,000 Bitcoin to user accounts.
620,000 Bitcoin. That is what, $43 billion?
Roughly. But here is the kicker. It was paper Bitcoin. It didn't exist on the blockchain. It was just numbers on a screen in Bitham's internal database.
So users woke up thinking they were billionaires, but the vault was actually empty.
Exactly. And the South Korean government went nuclear. They didn't just find Bitham, they immediately mandated compulsory external audits for all domestic exchanges. Upbit, Coinone, Corbit, everyone.
So they are moving from trust us to prove it.
They are demanding proof of solvency. The government is saying, we don't care what your internal spreadsheet says. We want to see the coins on the blockchain.
The contrast here is fascinating. The U.S. is fighting to protect the bank's business model. South Korea is fighting to verify basic reality.
And honestly, the Korean model is where we are heading globally. Audited infrastructure. You can't be a black box anymore. The industry is too big for, trust me, bro.
Speaking of global moves, we have to touch on the geopolitical angle quickly, because while the U.S. is stalled, other players are moving pieces on the board.
It is a financial rails war. We are seeing distinct camps forming.
We see the EU considering a ban on crypto transactions with Russia because Sberbank is launching crypto-backed loans. But the bigger story is China.
China is the elephant in the room. The PBOC People's Bank of China is integrating the digital yuan, the ECNY, into their banking system. But get this, they are paying interest on it.
Wait, the U.S. banks are fighting to ban interest on digital dollars, and China is mandating interest on digital yuan.
That is the strategic threat. If you are a merchant in Brazil or Africa, and the digital yuan pays you 3% simply for holding it, and the digital dollar pays you 0, which payment rail do you use?
You follow the yield. It is simple math.
Exactly. China is weaponizing the very thing U.S. banks are afraid of. They're using yield as a customer acquisition tool for their national currency.
So, bringing it all back home, Wednesday, Feb 11, we have got institutional rebalancing, minor pivots, regulatory gridlock. What does the price chart actually look like today?
It is ugly, frankly. Bitcoin failed that recovery at 71,000. We are trading below 67, down about 3.4% in the last 24 hours. The RSI, that's the relative strength index, is near 30, which means extreme pessimism.
Is there a floor, or are we in free fall?
The line in the sand is the 52-week low. $60,514. That is the critical support. If we break that, there is very little support until 56,000.
So if I am a listener trying to make sense of this, what is the actionable takeaway?
Stop looking at the price of Bitcoin as the only metric. You have to look at the structure.
Okay.
Watch the hybrid miners, TeraWulf, Cypher. They are decoupling from Bitcoin. Even if Bitcoin drops, their AI contracts are valuable. That is a hedge. And watch the stablecoin yield war.
Yeah.
If the U.S. bans it, money will flow to offshore issuers who allow it.
Capital goes where it is treated best.
Always.
Yeah.
It flows like water.
I want to leave the listener with one thought you mentioned earlier because it really stuck with me.
Yeah. We spend so much time debating, is crypto a scam or is it the future? But look at today's evidence. If a Bitcoin miner is valued for its power cable, not its crypto, and a bank buys Solana for its network speed, not its price, are we even investing in crypto anymore?
Or are we just investing in the next evolution of the power grid and the internet?
I think the lines are gone. The asset class has grown up, and growing up means becoming infrastructure.
Well, on that heavy note, we are going to wrap it up. A lot to chew on. Keep an eye on that jobs report that came out this morning. That is going to move the macro needle too. Keep your eyes on the plumbing, not just the price.
Thanks for listening to The Deep Dive. We will catch you next time.